Welcome, everybody. Welcome to Zoom at 8. We are here every Tuesday night. I am your host, Julie Ann Peterson. I am a loan officer, senior director at Old Capital Lending. And we have been here for over 4 years. We've been doing Zoom at 8. It's been I call it wildly successful, because we have we've met with lots and lots of industry experts that I bring to this live conversation just for you. So if you are new to multifamily, all you need is a Tuesday night to build your Rolodex, to build your partners, to build your investors, to build connections, right? This is a relationship business. And it started for me with Erica and David over 4 years ago. I met these guys and they're on Zoom at 8 now. And so you guys are going to get to know them. Now, what we're going to be talking about here shortly is infinite banking. And if you say, I don't know anything about that, well, I'm glad you're here. But maybe you say, it's not for me, and that's okay. But maybe it's for one of your investors, right? And you want to be the conduit to people like Erica and David. These guys are going to help you understand what the wealthy are doing to build and grow their long-term wealth. Okay, so I'm glad you're here. And there are people that come every week to Zoom at 8, and they become my partners. People that are, again, are industry experts who are making a difference, who can help you. So I am pleased tonight to bring to you two folks that I've known for over 4 years. And they started in the financial arena, and they're taking their financial knowledge and their investing knowledge, and they own a company called Infinity Investment Strategies. So we're going to be talking about Infinity Investment Strategies tonight. We're going to find out what they do and how they can make a difference for you and or for your investors. So let's find out. Infinity Investment Strategies is an independent wealth strategy firm that partners with multiple Fortune 500 companies to provide strategies for real estate investors and business owners. Being America's leading independent authorized infinite banking practitioners, David White and Erica Neal, they teach the infinite banking strategy and how to create cash flows from multiple asset classes used by the wealthy to achieve financial growth and generational wealth. So the question is, what is infinite banking? What is this concept? It's about increasing your leverage, lowering your taxes, lowering your risk, and increasing control. So let's know a little bit about David and Erica. So David, again, I met him. We were in a deal in San Angelo, Texas. Oh, he has 20 years plus of years of financial planning background. He's been in new single family development, multifamily syndication, and short-term rentals. So he knows what he's doing in real estate and how he can impact you and lives of others. Erica Neal, she's in Dallas as well. She was previously focused on accumulation and rate of return working for large organizations, and she now educates clients on efficient cash flow strategies and how to increase retirement income through infinite banking. So after working alongside for the same company or other companies, Erica and David decided to merge their practices and focus on their passion, which is real estate, and they're bringing that to you tonight. So I want to welcome to the studios of Zoom at 8, Erica Neal and David White. Welcome to Zoom at 8. How are you guys?
Doing well. Thank you, Julie.
It doesn't get any better than that, does it?
Yeah, thank you. What a great intro. I appreciate
that. Amazing.
That's awesome. You saved us a little bit of time, but yeah, I'm gonna basically just say a few things, and I'm gonna kick the ball to Erica. So basically, Erica's going to get into a little bit more of what you went over and kind of our background and who we are. I'm just going to go over kind of our processes. Erica really does a great job of running the first meeting. She sets a good foundation, very high level, and we'll start to hone in on what infinite banking is, what are the benefits, why do we want to emulate the banking system. So she's going to run tonight's meeting, and I'll definitely be here available for questions. I will then run a second meeting. So if there's any interest afterwards to dive deeper to get more of the details laid out, I will run that second meeting. And then we will actually go from there and look more into the specifics of tailoring a infinite banking strategy for each individual. So I kind of like to relate it to building a house, right? You want to lay a really good, solid foundation first on the strategy before you start hammering away at the details. So that's what Erica does a really good job of, laying that good foundation, setting that up so that, you know, we can definitely come back and really start to get into the details of the strategy, and then look at possibility of what that looks like for each individual, because the strategy is the same for all of us, but there is some differences in how we design these for each individual. And that's our expertise. So Erica, I'll go ahead and toss the ball to you and let you run tonight's presentation.
Absolutely. And you guys all come to find, you know, we're very visual people. So we've got lots of good visuals and pictures and all of that to kind of bring it full screen. Thank you so much for that intro, Julie, by the way. That was so comprehensive, and there's a lot more to it. But like David mentioned, we do have a process because infinite banking is nothing new. This is something that's been around for a very long time. I mean, over 100 years. But we want to make sure that we do a good job understanding the strategy, understanding the idea, understanding this concept, because that's really what it is. This is not a get rich quick scheme. This isn't something about, hey, I'm going to go out and chase rate of return. This is really understanding a way that we can use money and be efficient. And we're going to recapture the interest that we were previously paying to a bank and bring that back into our own compound interest curve. And really, David and mine's strength is making sure that, I'm going to go ahead and move on. Our strength is that we are authorized infinite banking practitioners. So we have the education, we have the background, we have the knowledge on infinite banking. We've gone through the Nelson Nass program, through the Infinite Banking Institute, and we've gotten our education and our background, gotten trained in this. This is something that, you know, you go through all the modules, you go through the proctored exam, you have to get your license in this, but they also monitor and regulate the things that David and I do, these policies that David and I put in place, because they want to make sure that we are maintaining the integrity of what infinite banking actually is about. So one thing I will say before we get into this, of course, you know, we would love to meet with all of you on doing the infinite banking, but if it is not us, one thing that is a must is you absolutely, if you're going to do infinite banking, need to work with an authorized practitioner. This ensures that you have someone that you have all of the background training and education on. And that's something, again, where David and I come in, is we don't just understand infinite banking, but we understand real estate and bridging these two asset classes together and making them work as one. So as we get into this, one thing to understand is, well, how do banks make money? And that's what we want to say, is we're going to recapture the interest that banks are currently getting and bring it into our own compound interest curve. And if we look at how banks make money, we can understand how they have become the most profitable industry in the world, more than pharmaceuticals, more than oil and gas. And let's take a look at this. This is going to be part of the mind shift. And you'll hear us say that over and over again. The mind shift is changing the way that we look at things from a consumer perspective to a banker perspective. Because infinite banking, bank on yourself, be your own bank. We keep using this word over and over again because we want to be the bank, but that means we need to shift the way that we think. So, for example, let's say, Julie, you make a deposit with me as your banker. I am your banker and you deposit money with me. And the question is, well, when we look at your deposits, are your deposits with my bank, are they my asset or my liability? Well, a lot of people think, oh, well, that's an asset for you, right? But it's not. On my balance sheet as a bank, your deposits become my liability. I owe those to you. However, when I take your money, Julie, and I'm going to loan it out to David, David's loan on my balance sheet now becomes an asset. So the asset and liability columns of a bank's balance sheet is different than ours. And that's where we're having this mind shift. So what's happening is, let's say I'm charging David 5.2%, right? And when I'm taking that money from David, I'm trickling down maybe 0.2% to Julie, right? Virtually nothing. So if we look at this, and if Julie deposited $10,000, what that means is I paid Julie $20. It cost me $20 to make 520 off of David. Well, a lot of people would look at this and think, oh, well, the total profit on this is $500, right? But that's not how we calculate business profit margins. When we understand looking at, okay, what's the total profit? What's the total cost? And understanding what the math is, the profit of 520, the cost of $20, if we divide those numbers, our total profit by our total investment amount of $20, that gives us a multiplier of 26. Said another way, that is a 2,600% return on money that wasn't even theirs, because all I did was take money from somebody else and pay Julie $20 with it. So it's just cyclical. This doesn't factor in fractional reserve banking or anything else. But the same industry that is making these types of returns is the same industry that we've bailed out twice, coming up on 3 times now in the last 10, 12 years. So these numbers you guys will notice are incredibly specific. We didn't just pull this out of a hat. These numbers actually come from the Bank of America Bauer report in 2016. These are real numbers being reported by real banks. So we're going to take a step back for a minute and think about this. Throughout this entire process, who gets to use the money, who gets to control the money, and who gets to make the money the entire time? The bank. So who do we want to be in this entire scenario? We want to become the bank. We want to be right here in the middle of everything, putting money in, funneling it out, funneling it in, and funneling it back out. We want to create the cyclical process, but we want to put it where we are in the middle and we get to recapture that interest instead of the bank doing it. So we're going to recreate this system here, but in our favor. Okay. Now, what is infinite banking? What is this all about? Well, what we're looking at is infinite banking is where we take a specially designed cash value life policy, and we are going to focus on getting the cash as heavy and as maximized as possible to get guaranteed interest and dividends. Okay. Now there's a lot of benefits we're going to go into here in just a minute, but essentially it is a specially designed cash value life policy where we're not focused on the death benefit. We're focused on the cash. Okay. We are going to take the cash out of that policy, leverage the cash to go out and invest in whatever we want. It could be single family, multifamily, business, oil, self-storage, Bitcoin. It doesn't matter. Go to Vegas and put it on black for all we care. The point is, everything you're doing outside of your policy, this is your rate of return. We would never, ever say, hey, give me your money. I'm going to go put it in this IBC policy and then don't do any real estate, right? Like all of you guys would laugh at me and walk away, as you should. The point to this is put it into the policy so you can go out and invest in all these various asset classes. Okay. So when we look at this, the point, David and I really try to bring up is there's no good or bad tool, but we need to understand the differences here. So if you have a regular bank account, like an IRA or a traditional bank account or a self-directed IRA, if you have 100 grand in there and you take out 70 to go into a real estate deal, you're going to go get all the cash flow and appreciation that you normally would. But the problem is you're only earning interest on the 30,000 that's left over. This is what we like to call opportunity cost. Okay, that's not a bad thing. It just is what it is. Now, when we look at infinite banking, on the other hand, we're saying, hey, I'm going to use this policy that I have built up $100,000 in, but when I take out that 70, I'm going to go put it into the same real estate deal, get the same cash flow, the same appreciation. The difference is that while I have my money out working for me in a deal, I am still allowing my dollars to accrue compound interest and dividends at the full $100,000 value. So we're doing what Robert Kiyosaki says, which is giving $1 multiple jobs. Okay. So this is saying, hey, I want to leverage my dollars in a more efficient and effective manner. Now, like I mentioned, David and I always say there's no such thing as a good tool or a bad tool. We come from the financial world and it's very much a, my daddy can beat up your daddy space, right? Like everybody's better than the other guy. But really what we have to understand is what tool are we using and what job is it being used for? Okay. So what I mean by that is that if I were to come to you and I say, hey, here's a hammer, is that a good tool or a bad tool? What would you say? Well, it depends, right? Like, what are we trying to do? And so that's what dictates on the savings dilemma here. What job are we trying to perform? And that's going to tell us what tool we need to use for that job to be efficient. So there's 3 functions of money. We have short-term, intermediate term, and long-term functions of money. Short-term, that's pretty self-explanatory. That's going to be our bank account, right? When we look at a bank account, most people are putting money in here because it's safe, which I always put in quotations, right? Because that's a relative word. It's safe and it's liquid. I can get to it. I can, go buy groceries, do whatever I need to do. The flip side of this is, though, that there's not really any growth inside of this account. That's okay. That's not what it's for. This is money that I need to use within the next 0 to 12 months. Otherwise, we're losing money due to inflation, okay? And a lot right now. Now let's go to the other end of the spectrum. We're going to focus on the investment side. Now, this is a very broad category. Investments can be, it could be our multifamily real estate deals. It could be single family. It could be a mutual fund stock portfolio, business, doesn't matter. Something that over the next 7 or more years, we're really wanting to come to fruition. Why do most people put money into this box? Well, generally speaking, we're hoping to see growth over some period of time. But the catch is that we have to acknowledge investments carry risk, and that's okay. We know they're not safe. And we also know that these investments are not immediately liquid. I cannot go get that money immediately if I needed it. So here's the dilemma that most people are faced with, but especially real estate investors. I want my money to be safe and liquid, but I have to sacrifice growth. But if I want growth, I have to sacrifice safety and liquidity. So I can either put my money into an account for the next, and use it within the next year, or lock it up for 7+. So there's this teeter-totter effect, and we have a massive gap here in the middle where I can't tell you how many conversations we have had with people saying, hey, I might be able to need this money right now, but I still need it to benefit me in the long run as well. How do I bridge the gap between my short-term bank account needs and my long-term investments? Okay. So when we look at these different tools, we need to have different characteristics that are not being taken care of so far. Said another way, I want to give myself the ability to earn guaranteed growth. My money needs to be safe. So when I go get it, it's there. It needs to be liquid and immediately available. I want to add some tax benefits in there, and it's going to be completely private. I'm really going to hone in on that here in just a minute. But all of these characteristics here, safety, liquidity, guaranteed growth, tax-free, private, this is why Warren Buffett, right, the granddaddy of all investing, he has actually coined this asset as the vault. So think of a vault like in your garage or basement. You can put money in when you want. You can take money out when you want. It's completely safe and shielded from outside harm. Who knows how much cash you have sitting in your vault at home? Just you, right? Unless you decide to tell somebody, it's completely secure. So this is where we start to see completely different asset classes that work together. This is like having a hammer, a saw, and a screwdriver all within your financial toolbox. They are different tools that do different things. Now, the question is, well, okay, I've got all these tools. How does this work together? How do I make a system here? Good question. I'm glad you asked. So we're going to take money out of the bank account and you use it to fund your vault or your IBC policy. You build up cash within that policy, which you then use to go out and invest in whatever you want. Okay. So you go out and invest, you go make your money. You're then going to cash flow that money back into your IBC policy. But because you're earning more than what you're putting into your policy, you have leftover money that trickles down into your bank account. But now guess what? Now you're too liquid in your bank account. So you need to put more money into your policy so you can do more investing, and you rinse and repeat the process over and over and over. So we have this, Robert Kiyosaki, I love the guy. He talks about the velocity of money. I like to call this the flow and grow, where we are consistently allowing our money to earn and grow and compound so that we never, ever, ever lose a day of interest. Okay. Now, obviously there's some subliminal messaging here, right? Like that is what David and I do, is we help people create these cash flow strategies flowing from one end of the spectrum to the other and back, so that we have the ability to allow our money to flow and grow. It's not stinky, stagnant, moldy money, right? That's what we call it. Moldy money just sitting there is kind of gross. So the idea is, again, we want to help people not just put money into this policy, right? Like we're not transactional. This isn't something where we say, oh, hey, Julie, here's an IBC policy. Then we slap your butt, you're out the door, right? Like We've been around for a long time. We work with people, we've created relationships, and we want to help people not just understand it, not just set it up, but put it in place, getting it into these investments, and then rinsing and repeating the process over and over and over. So this is how we put it in place. Now, the question is, when we look at these characteristics here, there's only one financial asset that checks off every single one of these boxes. And that is why we are using these policies. They're whole life policies that are issued by A-rated, mutually owned, dividend paying companies. Now, notice I just said a lot of words there. We are incredibly specific about the type of policy and type of company that we use for these policies, okay? Now, Julie mentioned we are independent, so we partner with multiple Fortune 500 companies. So we have the ability to pick and choose. We pit them up against each other quite often to say, hey, who really wants to work for this business? But the point is, we want to make sure that all of these guarantees are built in. This is incredibly important. This is the only type of policy that has, number one, the death benefit guaranteed, meaning some people want a little bit, some people want a lot. It doesn't matter. The death benefit is not the point of these policies, okay? But whatever it is guaranteed to grow and increase over time. This is what we call inflation adjusted. We know that $1 million today is not the same as $1 million in 10, 20, 30 years, okay? Now, you also have a premium that is guaranteed to remain level. They can never, ever charge you more or increase how much you're putting in just because you get older and less healthy. This is the only type of policy that is guaranteed to remain level. You can even stop it if you want to. Again, we'll kind of get into more details on that later. But the point is, it is guaranteed to remain level, can never increase unless you want to. Now, inside of this policy, you have a cash value that is guaranteed to increase every single year, regardless of what the market is doing. It is earning, growing, compounding. We know the compound interest curve, right? It takes off here and then it's going to grow exponentially, all right? Now you will notice on the right-hand side, there is one aspect of this that is non-guaranteed, which is the future annual dividends. So these policies do earn dividends. Now, whenever they are distributed, they get reinvested back into your cash, and all that does is make your cash value grow even faster. Now, a couple of things on this. They are non-guaranteed, but we are using mutually owned companies, which means not me, not you, none of us can buy stock in these guys. They are privately owned. They are not shared on the stock exchange. They don't have an 8-figure CEO. We don't have shareholders to compete with. They are mutually owned by the people who have their policies, okay? Now, are they guaranteed? No. But the companies we use have been around since 1858, 1872, a really long friggin' time, right? And every single year since their inception, they have paid a dividend. So, are they guaranteed? No. Have they paid them for over 150 years straight through every economic cycle we have ever seen as a country? Yes. Feel free to take that however you want. Now, like David mentioned, the customization and the tailoring aspect to this is so detailed. We can get into all the minutia of that. We can adjust every single little piece of this for every single person. This is just a general overview of how these policies work on the inside, but know if you decide to say, hey, I want to learn a little bit more, we can get to this to the point where we can say, hey, I want to do more, I want to do less, I want to change it. All of that comes into the customization part, okay? Now, let's look at the actual strategy because, again, that's what this is all about. There are 4 pillars to infinite banking, 4 items that we say, hey, if I were to take infinite banking and I'm going to do a plug and play. Plug and play means, hey, we're not competing. This is not an either or. This is a yes and. I'm going to put this in the middle of everything that I'm doing and plug and go ahead and keep doing what I'm doing. It's just going to fall smack dab in the middle. So there's 4 things that we're going to look at. How does infinite banking affect our overall picture? Okay, lower taxes is obviously great. Increased leverage, that's a real estate investor's favorite word. Increased control. I think all of us, if we admit it, we have some control issues. And then lastly, we have lower risk, right? So again, let's dive into this one by one. Lower taxes. So when we're talking about infinite banking, the number one thing to understand is if you use your IBC policy to invest in a deal, you get to take advantage of the full depreciation that's available. cost segregation, bonus depreciation, whatever you have available, you get to use whatever that is 100%. Okay. There's no, excuses or, like a self-directed IRA, you kind of forego the depreciation. It gets treated same as cash. So all the depreciation is available. You are also, as you're borrowing against your policy, right? And you're borrowing against that, there's a simple interest on those loans. That interest, again, we're going to get into more detail. The interest that you're paying on your policy is an additional tax deduction. If you're using that for your business, if you're using that for real estate, we talked to Tom Wheelwright. I don't know if you guys know him. He's awesome. He has a whole chapter on this. He was talking about it in his book, but he specifically talks about using these policies, taking the loan out, and that interest being an additional tax deduction for your write-offs today. Now, you are also going to be able to use your money and the growth, right? As it's going in and as it's growing, you get to use that completely tax-free through the loan strategy, right? We're going to look at that here shortly. All your money and the growth completely tax-free while you're working, building, and growing. There's no UBIT. There's no tax filing of any kind because remember, it's private. So no filing of any kind. Now, when we get to this point in our life, David and I don't really like the word retirement because that's kind of weird. I don't know if we'll ever retire, but all of us are doing one thing, which is we are building up as many cash flow assets as we can. We want our money to work harder for us than we do for it. And these policies are no different. This becomes one more cash flow arrow in our quiver so that when we get to a point where we just want to sit back and collect a check and just sit in that distribution phase, these policies will spit out a guaranteed tax-free income to you for the rest of your life. You call us and say, hey, David and Erica, I don't want to put money in. I want to take money out. And it will spit out a guaranteed tax-free pension to you for the rest of your life, along with all the other assets that you've built up. Now, once we've taken depreciation up front, we wrote off all these deductions up front. We got to use our money tax-free, no UBIT, and we used a tax-free income. After all of that, when we graduate from this world and we move on, everything we leave behind is completely tax-free to the next generation. No inheritance, no estate tax, no wills, no probate, no nothing. This is the most efficient way to transfer wealth from one generation to the next. So much so they wrote a book about it. So if you want to write this down and we can put it in the chat, it's called What Would the Rockefellers Do? So they call it cash flow banking. But the point is, if anybody knows anything about generational wealth, it's these guys, right? Maintaining it without getting eaten alive by inheritance and estate taxes. Now let's talk about control. Two primary questions we get here is, okay, this sounds all great, but how easy is it to get my money? Well, you can take your money out as a loan or as a withdrawal. Doesn't matter. However you want to take it out is fine. We are going to focus on the loans, and I'll show you why here in a little bit. But the point is, when you go to get your money, there are no questions asked. I say no. There's two questions they're going to ask you. How much do you want and where do you want it sent? That's it. Doesn't matter what you're doing, when you're going to put it back, whose deal. Who cares? Again, go to Vegas, put it all in black for what we care. It's your money. You get to decide when you take it out. Now, you are also paying back these loans on your own schedule. Now, the company is going to set the interest rate. They set the simple interest rate, but you get to dictate how you pay that back. I don't know how you guys did during the COVID and 2020 eviction moratoriums and all of that, but we had a few people that had distribution stopped, or we had some people that weren't getting deals, or things may have not gone to plan. So if you do not want to pay that loan back at that time, you can say, hey, I'm not going to make any payments. Great. David and I we did some single family new development, and we had a guy that the project was supposed to take about 12 months, 18 months due to all the shortages and all of that. Project took over 2 years to complete. The entire time he did not make a single policy loan payment. He just kept using his money, funneling it into the project. Once he finished, he got his money, paid it off all at once, and then just rinsed and repeated the process. There's no penalties, late fees, me and David knocking on your door. You got to make a payment. You get to control that. And then of course, right, you have complete access to your cash value. This 95 to 97% number, again, we can explain a little bit more about what that looks like on the cash value. But the point is, David and I do not play games with these policies that have surrender charges or vesting periods, right? Like, we've seen them where you can't access your money for like 10 or 12 years. Hard pass. That's not what we do. Now, your savings is also up to you. The second question we get is, well, how much does this thing cost? How much does a house cost? right? Like you can go as big or as little as you want. It's completely up to you. That's where the tailoring aspect comes in. But the point is, you have the ability to say what you want your base minimum to be, but you have the ability to put over and above that with these PUAs. This stands for paid up additions. This is just additional cash that you have funneling into this policy that builds up your cash faster. Think of it like your house. You know what your mortgage payment is, but you can pay over your mortgage to build up your equity faster. Okay. This is similar. The difference is this builds up cash a lot faster than a mortgage amortization schedule. Okay. So you're going to every year see cash growing. And then lastly, I already kind of touched on this. They're guaranteed to grow. They've been consistent on their dividends, but they are incredibly accurate on their projections. So if you were to look at these policies and see what they're mapping out over the next 10, 20, 30 years, I personally pulled the dividend history, and what I found was they have either met or exceeded their projected dividend every single year for the last, I just looked at the last 50 years, except for two. The 2 years they missed their projection, they missed it by 0.5%. So we're not just throwing stuff at the wall to see what sticks. These are incredibly realistic. These are incredibly accurate. And it's a good way to map out your business ledger so you know what to expect in that time period. This is a great way to have control over one thing in our life because everything else seems to kind of not be that way. Now let's talk about the risk factors. Most people think about the market, which is definitely a concern, but there's a lot of what we call wealth eroding factors that we need to consider and protect our assets from. So market crashes, of course, these are guaranteed to grow, no correlation to the stock market whatsoever. This is the most uncorrelated asset. So if the market goes up, your IBC policy goes up. If the market goes down, your IBC policy still goes up. Here's the thing. When does most real estate opportunity tend to present itself? When the market's down. So if we have our cash and our liquidity tied to the market, that means that we're going to have to lock in losses to go take advantage of this deal. That doesn't make sense. This puts us in a position of true buying power where we are always on the upside. Okay. We are also protected from creditors and the IRS. So if we have a financial hardship, if they put a tax lien on you, God forbid you make an accounting mistake and the IRS comes knocking on your door, we know they don't pull their punches. They can come after your house, your car, your dog, doesn't matter. They can come after anything and everything. Now, this is going to vary state to state and all that, but I will say, for example, Texas, I know California does this if you have your spouse on there, but again, this is kind of the tailoring aspect. But for example, Texas 100% protects all of the cash inside of these policies from being seized by creditors and or the IRS. This is huge for real estate investors. This is huge for business owners. I personally think this is for every single person, regardless of their career path. Moving on. Now, we also know run on the banks. We've seen this a little bit lately on a local level. We haven't seen it necessarily on a national level yet, but what we know is banks have little to no reserves. Did y'all know in March, it was March 14th of 2020, major banks with $10 million in assets or more had their reserve requirements lowered to 0%. 0%, y'all. Like we haven't been in this situation before. Like we haven't learned our lesson. But the point is they have low reserves. These policies, these companies that we work with, in order to get this A+ rating that I mentioned earlier, they have to have a minimum of 100% liquidity on hand for any dollar that they guarantee. So if every single policyholder wanted to go get their cash, they would have the reserves to be able to do so. We also know banks can tighten up on credit expansion. So we had a guy, North Carolina, he owns 120 units outright, didn't syndicate it. But during 2020, he needed some cash to funnel into his property for some time. He went to the bank. He wanted to get a HELOC on his home. He had over $1 million in equity. He went to the bank and the bank told him no. This was like May or June of 2020, right? They just flat out said no because they weren't certain on what was going to happen. These policies, you have no concerns over that. And the last thing I'll say is we have a concern against predators. Y'all, this is just a sue happy world. We know it. It's just part of our lives. This could be a disgruntled investor. God forbid somebody breaks the bad boy rule, right? It could be something completely outside of business. It could be a car wreck, a clumsy tenant, whatever. If I rear end someone and their neck hurts a little bit too bad, they can sue me, my house. Again, these policies, the cash inside of it is protected from being sued against, seized, all of those things. Okay. Now let's talk about leverage, because I know this is what everybody was waiting for. So if you are going to show your financial reporting and you need to show net worth or liquidity on your personal financial statement, okay, you can use 100% of the cash value inside of your IBC policy to go towards your net worth and liquidity. I don't care if you're an LP, GP, KP, doesn't matter, right? OG, all of them. You get to use 100% of your cash value to go towards your liquidity and net worth. Lenders love this because they know it's guaranteed. Yes, Julie, go ahead.
Well, I'm going to tell you that when you have an IRA, solo 401k, you've got a regular something at your work, you can throw that in on your net worth, but it doesn't go for your liquidity. So this is a big, great strategy, everybody, because you can utilize that 401k cash value. That is huge. So make sure we understand that.
Yes, and that's a huge point too. It's what we've told people is sometimes they'll do 0%. We've seen them do up to 50% sometimes, but even that in today's market and the volatility, we're really seeing it more on that, Julie, exactly like you said, on that 0% side. So you're absolutely right. Now, let's say, I'll tell you guys, I have an 8-year-old and a 14-year-old. David also has a 14, 15-year-old. But if our kids decide to go to school and they're filling out the FAFSA or filling out scholarship applications, whatever it might be, if you've been through that, you know they're going to use everything against you. 529s, IRAs, 401ks, whatever it might be. You do not have to disclose a single dollar that's inside of your IBC policy. They cannot use that against you when you're qualifying for those different programs. David dealt with this with his oldest. I'm going to age you a little bit, David. David's oldest, right, just graduated from college. But when she was applying, he was able to shield and not disclose a majority of his assets inside of this policy and allow her to qualify for more scholarship programs and things like that. So again, you get to open the door to your vault when you want to, but you can shield and hide it when you decide to as well. So there's some flexibility on that. Now let's talk about the arbitrage piece. When you are borrowing against, the term for this is borrowing against your cash value, they do not report these loans. They don't affect your debt to equity, right? Income ratio, any of that. No credit scoring, any of that. David and I personally, we only use companies that have non-recognized loans. What that means is this allows you to earn continuous compound interest even when you have money outside of the policy working for you, okay? So here's an example of that. Again, if you have an IRA or a bank account, we're going to go through this again. When you take this money out, it's going into your investment and you're getting a rate of return outside of your IRA or your bank account. That's where that 30,000 comes in that's left over. On the loan strategy, when you take out this 70, there's a simple interest rate that's attached to that loan. You go out and you're going to be earning in whatever investment. Again, that's completely separate. But think about this where you are currently. When you get a distribution or some sort of payout from an investment that you're in, currently, what do you do with that money? A lot of people would say, oh, well, I just take it, I put it into my bank account so I can invest it again, right? Great. The same system applies. But the difference is when you get cash flow from your investment, whatever that might be, you're going to put it into your IBC bank instead of your traditional bank. And here you've been earning compound interest on the full 100,000. So you're earning more inside your policy. You're getting an investment rate of return outside of the policy. Okay. So again, this is the term borrowing against. We'll go into some more detail on this. And that's really where we go into this part 2 and understanding the mechanics. So we understand more about the strategy. We understand, like David said, the foundation of what are these policies? How do they work? What are the tax implications, right? But there is a lot more detail to this. So when we go into part 2, if this is something you decide, hey, I'd like to learn a little bit more details on this, great. Well, part 2, we're going to talk more about, okay, how does the earning compound interest work compared to the simple interest on the loans? How do we take advantage of the IRS tax code, right? This is written into the IRS tax code, code 7702, and we want to maximize the cash that we can get into this IBC policy. How do we structure it that way? We have a fantastic example of investing in a multifamily deal, right? A multifamily syndication with an IBC strategy compared to a cash strategy. We also have an IBC cash flow model. I worked with David on this. Like Julie said, he's done some short-term rentals, Airbnbs. So we've talked about how do we use these policies to do short-term rentals, Airbnbs. I've used them to do hard money loans and passive investing and whatever. So there's a lot of ways, right? That's why I put even more. There's so many different ways that this can be used, and that's where the tailoring aspect comes in. But if this is something you want to learn a little bit more about, we'd love to meet with you and go into more details on the mechanics of all of this. So what I'll wrap up with here is, mine and David's background, just so you guys know, we're not the only infinite banking practitioners out there, but we do have a lot of experience across multiple fronts. So we have over 32 years combined of traditional financial planning experience. David comes from like the stockbroker, Wall Street world. I did more of like the pension planning and retirement planning. But we are on an independent platform. So we have multiple Fortune 500 companies that we work with. We pit them up against one another. We will look at different options for different people to see, hey, which one's going to make the most sense. We've even had companies where we say, hey, we want to go with you, but this company gave us a better offer. Are you willing to match it? And they will, because they're competing for our clients. We are authorized practitioners through the Nelson Nash Institute. We work specifically with real estate investors and business owners. Why? Because we're real estate investors and business owners ourselves. We've done a variety of different real estate investments, but we like to work with people in this space because they have, number one, the right mindset. We become a lot of good relationships there. But what I will say, I would say probably the number one piece of feedback that we've personally gotten is, there's a lot of people out there that know infinite banking. There's people out there that know real estate. But understanding how to merge these worlds and make them become one synergistic strategy, that's mine and David's specialty, and that's exactly what we offer. This QR code here, if you scan that, it will take you to our calendar, or we'll also put our email in the chat. You can shoot us an email, and we can find a time to connect, chat, do all of those things, and obviously provide more details for those that want to learn more.
You kept the energy the entire time, Erica. I am impressed.
I'm gonna have to
hang
send
out
this
with
to Meryl
people
and
like
tell him
me.
that I slowed down talking.
Oh my
I really
God, that's
tried
so
to.
awesome. Okay. Does anybody have any questions? This is a live conversation. What can we ask our professionals on this live conversation? I have one. Oh, okay. Let me call on me. I am curious. We know about this foreclosure situation in Houston. People put their hard-earned money into those deals. Somebody took their money out of their infinite banking. How does that work?
Yeah, great question. Great question. So like I'll relate that to the way JCPenney's used it in the Great Depression. So JCPenney's was in the Great Depression, they were not selling retail at all. So they were losing money, right? Or weren't making any money, but they had to pay their employees. They leveraged their corporate owned life insurance policy. They borrowed against it. Okay. That means that they had a loan against their policy out and they were using it to run their business. Well, how did they pay that back? Well, over time, they started building back the retail because people started buying the retail and they were able to leverage that loan back. They didn't lose the future value or the growth of that value in those several years of that loan. So if you think about it, if you have bank money that you go and you invest and you lose that, that's it. It's gone. It's zero. You have to recoup that. Let's just say 100 grand. You have to now resave that 100 grand. Let's say it takes you 2 years to resave that 100 grand. You have 2 years of time value of money gone, right? If you borrow against your policy, okay, you lose that 100 grand, you still lose the 100 grand, you got to pay the 100 grand back, right? You still have to do that just as you would as a bank account. But that leveraged loan is still earning dividends and interest, and it's earning more than what you're paying on the loan. So you have some of that time value of money to be able to, you still have that recoup. So you can kind of give yourself, you can either surrender the policy and let it go, or you can give yourself a chance to dig yourself out of that hole, resave that money, but keep that interest and those earnings intact for however long it took you to resave that money.
It gives you the ability to really mitigate, right, the loss of that real estate investment, right? What happens outside the policy happens outside the policy. But if you can mitigate that loss by giving yourself the ability to continue to earn interest on that money, yeah, that's incredibly powerful. And I don't know why. I usually have a whole slide over all these different examples of how infinite banking's been used, and it was not in there. So I apologize about that.
Do you have it now, or like, could you find it or no?
I do.
examples?
Yeah, I have it handy right here. If y'all want to see it, I can definitely share it right now. Let me get back into
I think it would be helpful.
Okay, absolutely. And
So-
the reason I say this is, you know, I will say, I think David and I have quite a few people that have asked us this one question, which is, you know, if this is so great, why isn't everybody doing it? And what we like to point out is it's been around for a very long time. This is nothing new. And if we really look at these different examples, we can see how it's been used. So these are a couple of examples of this.
It's also who's your everybody, right? Like,
yeah,
if your everybody is Joe Schmoes down the street with subscription to Forbes magazines that have all their money in Fidelity, they don't know infinite banking. But as you get more and more into the financially mature, financially elite crowd, you will start to hear that more because of people that are actually doing it. So yeah, who is your
that's
everybody?
huge. Yeah. So a couple of examples here, right here. This is, I don't know if you can tell what this picture is. This is Rockefeller Center. So fun fact, this is the largest privately funded construction project ever built. So Great Depression, Rockefeller wants to build this monstrosity, but he goes to get a loan at the bank and they say no. Obviously, it's the Great Depression. They're not even lending money to JD Rockefeller at this point. So in all his ego, he fully funded the entire construction of Rockefeller Center with his personal cash value life policy. During the Great Depression, it wasn't affected by the market and there was no restrictions to the access of his cash. Same thing, Walt Disney. He had a movie company, but he wanted to start a theme park. He went to the bank and they told him no, wouldn't do it. It was too risky. Imagine being the banker that told Walt Disney no to start a theme park, right? Like, oops. But the point is, the first money ever funded into the Walt Disney World theme park came from his personal cash value life policy. Doris Christopher was a home ec teacher in the 80s. She wanted to start Pampered Chef, couldn't get a loan, took $5,000 from her policy, started Pampered Chef, sold it in 2016 to Berkshire Hathaway for $1.6 billion. There's a family out in California. So Foster Farms, they're a great example because they have used these policies, not just for their business, but also for their generational wealth. So it's really twofold on this, maintaining their business. And they're the largest chicken producer in California. We see politicians all the time. Joe Biden, Donald Trump, John McCain, the Roosevelts, the Kennedys, all of these guys have used these policies to fund their campaigns and their personal investments. So there's a couple of things on this. Number one, the question is, oh, what about legislation changes and this and that? If we want our money to remain protected and continue to get tax benefits, shouldn't we put it in the same places as the people who write the laws? Because they have, and again, these policies have remained steady for over 100 years. That's not by mistake. Number two, my joke is, if Republicans and Democrats can agree on something, you know it's got to be good, right? Like if these two guys can agree on something, we know there's something there. And then there's so many examples, but JCPenney is kind of our poster child for leverage. If you get a chance, I recommend that you look up Boley-Coley. This stands for bank-owned and corporate-owned life insurance. The largest banks and the largest corporations hold a majority of their assets inside of these policies. Wells Fargo and Bank of America have over 50% of their cash assets inside of a Boley. But if you go talk to one of their advisors, they'll tell you to buy a term and invest the difference. But JCPenney, like I said, they're our poster child for leverage. And what they did was same thing, Great Depression hit, like David said, and they took a loan against their corporate-owned life insurance policy and used that to pay every JCPenney employee throughout the entire Great Depression. Again, wasn't affected by the market, no restriction to cash, and they knew they could weather the storm. And then when they started generating revenue again, pay that loan back at their own pace, at their own discretion. So how do you put a value on that? It's just
there's
so
actually
invaluable.
There's actually syndication teams that I know of specifically that I've helped actually do this strategy during 2020 when they basically had to stop cash flow. They had been doing banking as a business where they all kind of leveraged it to use it as key man insurance against each other, against each partners. And they basically used the LLC as access of ownership of the policy, and it was all divided evenly, and they all funded it evenly. Well, they leveraged the policy to cash flow investors so that they did not stop cash flow, and basically just refunded that as cash started to come back. So they were able to continue cash flowing investors, keep the earnings on their money intact in the policy, and then just pay it back as money came back, from government help and other subsidies. And then of course, as, just general cash flow picked back up. So, talked to a lot of their investors, and man, just the ability to continue to be a team that continue to do that and have a strategy like that was just a phenomenal feat to be able to do during that time.
Certainly. Yeah, great. I'm glad you shared that information.
Yeah, thanks for letting me wrap that up. I usually have it built in there. It just came out.
That's excellent. Is there anybody in the house that has a question besides me? Anybody? I see. No questions. You guys covered it all. Very thorough. I have used my policy before, and I did it against my life insurance policy, and paid it back, and it works very, very nicely. I love the fact that you continue to get paid interest. I think that is phenomenal. How many times you take it out of the bank and you don't get anything? So yeah. I love that concept.
Moses,
right.
Did you have a question? I see a hand raised.
Yes.
Oh, yes, Moses.
Question I have, you said you could front load the policy with cash by having paid up addition.
Yep.
Is there a time you can drop the paid up addition, and does the base premium go up when you drop it?
Good question. So on the design, right, what we're going to look at is, can you front load the policy and can you drop off the paid up additions? The answer is yes. So what we're going to do, and we talk a little bit more in depth about this on meeting 2, is we're really going to focus on getting as many PUAs, the cash, into this policy within the first few years, because we want to start kickstarting that compound interest curve, right? I think David uses the example of a rocket. The rocket, right? We need to break through the atmosphere, and then it's just smooth coasting from there. Same thing goes within these policies. We want to get as much cash as we can in for the first few years. And then after that, you can drop the PUA. Most of the time we do. And then you're smooth sailing and you're earning. I mean, it's a multiplier. If I'm putting in, we just use an easy number. If I'm putting in 100 grand, I'm getting 110. I'm getting 120. I'm getting 200. This thing starts to exponentially compound on itself. Now, does the premium automatically increase? No. But do you have the ability to increase it if you so chose to do so? Yes. And that's where that strategy is going to come in. And David and I are going to work with each person and say, hey, does it make sense to increase the premium? And if so, what does that look like? And I will say probably 99.9% of the policies that we write are designed so that they can get bigger and grow with you over time as your business expands. I think there might have only been like 1 or 2 people we've ever written a policy for that was just a wham, bam, start and go full speed. Most of these grow and expand and grow with you as your business and as your real estate portfolio grows.
Yeah, a lot of flexibility. Base can remain level the whole time. It never will automatically increase, like she said. The PUAs are optional, even if we put them on. Those are optional. You can do, 0 of the PUAs, or you can do the max of the PUA rider that you have on there. So a lot of flexibility on how these are funded. There's even options to reduce paid up to have the premium paid for itself if we have a rough year. So we will go through all of those in detail. Meeting 2, we're going to dive into a lot more detail of how we're actually able to leverage this policy, what the insurance company's doing, how that actually works, going through examples. The tailoring aspect is where we'll get to actually looking at an illustration software. You'll see me in the software designing it. We'll break down every single thing, all the sections, all the riders, the caption, the premium, the flexibility. When does it pay for itself if it needs to? How can we pull income from it? What does that look like? So yeah, we'll definitely get into that. But my point is there's a lot of flexibility, a lot more than what people really understand about these policies, and that's really what we go over.
Awesome.
Question.
Awesome. Adriana, do you have a question?
Yes. So if I have a child that is of age 21, 22, can we buy a policy on her or his name and be able to use that policy for that?
Absolutely. Yeah, a lot of people do. They use their children for it. So there's basically owners of the policy, payers of the policy. There's an insured person, and then there's a beneficiary. The insured person stays the same, and it has to be a person. The beneficiary can be anybody and can change at any time, and it can be a company, an entity, it can be a trust. The owner and the payer can be separate people as well. So yes, you as a parent can be owner and payer. So as owner and payer, you have complete control of that cash. Then your child is the beneficiary or is the insured, and then beneficiary can be their children. It can be a trust. It can be anything that you choose to be. But yes, you absolutely can. And a lot of people do that for their children, either to leverage it as banking, teach them how to bank on it, and hand it over to them maybe when they get married, things like that. But yes, it's definitely a strategy.
Because in my case, for example, I'm a lot older than her, so probably a policy will be a lot cheaper, and so I think I can probably leverage the money that way.
Yes.
Right?
Yep. There is, and that's a good point. But I will say that there's a little misconception about age and it being too expensive. I'll say this. So let's just say you have a 60-year-old. Okay. So you have a 60-year-old and a 30. So let's say a 60-year-old and then his 30-year-old self. Okay. We can design a policy that will be equal in cash for that 60-year-old and his 30-year-old self, right? The only difference is that 30-year-old design will have a larger death benefit attached to it because he's younger and it'll purchase more death benefit. The 60-year-old will have a lower death benefit attached to it. But cash-wise, we can design them the same. We can get the same funding. We can get all of that leverage piece of the cash design very similar. It's only that the difference is of what death benefit is attached to it.
Right. And that will make
That's
sense.
a good point, because a lot of people think, oh, if we're using a life insurance policy, I might be too old. And that's not true. It's not about, again, like I said, it's not about the death benefit, it's about the cash. But if, Adriana, to your point, if it is something where we need to use someone else, as long as you have an insurable interest on them, you have the ability to use someone else and still benefit from the cash. So there's a lot of strategic ways to structure that.
All
Awesome.
right. Thank you, guys. It's fantastic. I'm so glad it only took us 4 years to get you on. But if you do need to and want, not just need, but want to have a second phase 2, right? What did you say? What did you call it?
Part 2. Yep. you
Part
got it.
2. Make sure you reach out to David or to Erica. They can get you set up. That QR code. You can use that to schedule, and that will also work on the YouTube when we launch this. Okay. And also their information is in the chat. So thank you, guys. Fantastic. We'd love it if you stayed. We're going to move on to the next phase, which is our breakout rooms. If you need to leave, Erica and David, thank you. If you need to leave, thank you.